Welcome to the next in a series of PSP educational workshops. My name is Jamie Austin, and today's topic is accounting can be fun. And I promise you, these two gentlemen are going to make it fun for us. With us today is Greg Wozniak of Markham LLP and Tom Fazio of Card Connect. So welcome, Greg, and welcome, Tom.
Thank you, Jamie. Hello, Tom.
Good morning,
All
guys.
right.
Good to see you.
It
Thanks
is
for having
always a
us.
pleasure to have you guys on board. So, Greg, I want to start with you and say, because you're the accountant, how is accounting fun?
All right, next question.
Yeah.
Okay, next question is.
Ask me on April 16th, not now. Well, accounting,
there you
like
go.
all of our professions, we're only doing what we're doing because we like people. So we're all in this group together because we hopefully like what we do. And we also like people, and that helps the networking side of all we do, trying to expand business. And that's Tom and I were actually talking earlier about the power of networking, but it's really, I find, as much as we network here, I try to emphasize that it's the clients. We get more referrals from our existing clients than we do from any third party referral source. So always, 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 and the number one client is the one you have, not necessarily the next one. So we're always, trying to do that. And we also try to be social, try to be nice to our clients. So our clients really become part of the family and become friends. They're not adversarial. They understand it's still business, but you always want to be friendly because I'm not a doctor. We're only accountants.
So what you're saying is you're breaking the stereotype of what we know of as the accountant, as the number cruncher. There's more to it than that. And I know the one thing that you want to talk about, which is a big topic right now, and I know it's a pandemic related issue, is that ERTC thing. You want to talk about that first. Tell us what is ERTC, and then what is it all about?
Yeah, thanks, Jamie. A few things we try to do here as accountants, what I try to be and differentiate ourselves from a regular accounting firm is not just doing tax preparation. We don't compete with H&R Block. We don't just do tax returns. When we have an opportunity, we dissect, we pull on threads, and we look at opportunities. Probably 98% of my clients are pass-through entities. If we do financial statements, they're required for banks or maybe third parties or a transaction. But the owners of companies, what's near and dear is income, but not paying income taxes. So we try to mitigate those through various planning processes within the entity return and personal. Something that has come up, though, since that pandemic started, besides PPP, which everybody hopefully knows, there was 2 tranches at it. Hello, Patrick. There was 2 tranches at PPP1, which a lot of companies got. I do have some clients who gave the money back because there was a lot of concern from the IRS of fraud. PPP2, a lot of companies got if they were affected and still affected by COVID. What additionally came out of that was something called the Employer Retention Tax Credit. It was started right after PPP1, but when it started in 2020, it was sort of an either or. So everybody went for PPP because it's totally tax-free. It was easier to compute, easier to get. The Employer Retention Tax Credit in the initial year is really 2 general ways, 3 different calculations for the Employee Retention Tax Credit. It's an actual, now it's not a credit. It started out as a credit because it was going to reduce your payroll at the time. Now it's truly refundable. So even though it's called a credit, it really should be the Employee Retention Tax Refund because companies are getting refunds from the IRS on payroll related to COVID. 2 different ways. The first one is if the entity had a business reduction in as far as revenue. We have a lot of clients that actually the net income went up. Clients got smart. Unfortunately, they had to either lay off people, they stopped paying rent, their net income went up, but their revenue went down. You don't always need a lot of revenue to make profits. You just need profits to make profits. The employee retention credit worked in 2020. If your quarterly revenue went down, and it's the same method as your tax, so it's either cash basis, accrual basis, follows your tax return. If your revenue went down in a quarter over the same quarter of 2019, you can qualify for the employment retention tax credit. It has nothing to do with COVID. You could just be a bad business owner or had a bad product. Something went bad and your revenue went down. Obviously, during COVID periods, most of it was due to COVID, but there's no direct linkage to COVID. It's direct linkage to revenue and a direct linkage to how you report your tax. We have a lot of clients, for instance, in the advertising world. They do experiential type advertising, so they actually put on events. As you can imagine, during COVID, there was no events. There was no events happening at any catering facilities. There was no events at Times Square. There was no grand opening of a new iPhone or anything. Their revenue went down, but these companies also did digital media. So they concentrated clearly for everything being remote, concentrate on digital media. And so their net income went up, but their revenue went from $40 million to $20 million. They qualified for ERTC. And as I said, in 2020, your revenue had to be down 50% compared to a similar quarter in 2019. I'll get to the fourth quarter because there's a quirk in there that not many people know. In 2021, towards the end of 20, between the Trump and Biden administration, COVID did not go away. They knew they had to incentivize companies to stay in business, to keep people off the unemployment line. And that's really what this is. It's really subsidized unemployment. The barometer or measuring stick is 20% in 21 versus 2019. Again, you skip over 20, so it's 2019 is the base period. We have a lot more clients that maybe their revenue went down due to either shrinkage, getting a little smarter. If that quarter is down 20% over 2019, you qualify for ERTC. The amounts you could get for 2020 are up to $5,000 per employee. In 2021, it could be up to $21,000 per employee, $7,000 a quarter, first, second, and third quarter. If you qualify, you can get $21,000 based upon the amount of wages. We also have to take into effect if they've had PPP, because you can't double dip. If they have R&D, we have to take that into consideration as well. But typically, if you're going to qualify, you're going to get some money. What a lot of people don't know is there is also a look back period. If your prior quarter qualifies, you get it for your current quarter. So 2 quarters in 2020 or 21, 1 quarter rather, if you meet that 50 or 20%, you can actually get the second quarter. So you could qualify for 2 quarters. A quirk in that too is fourth quarter of 2020. If your revenue is down more than 20%, but less than 50, you don't qualify in 2020. However, because of that look back quarter, you could qualify in the first quarter of 21. We're doing that now for a client. They're getting $2.5 million, a large company. They have 400 employees, but their revenue was down 22% in the fourth quarter of 2020. They're qualifying first quarter 21, getting up to $2.5 million. We haven't completed a calculation yet, but yes, you can imagine the magnitude of these. Third-party companies, I'll get to the third way you could qualify, where those are really both revenue, A and B, 2021. The other way per the IRS mandates is if you were directly shut down because of government mandates to shut down. So if you think maybe a nursery school, a court system, so you couldn't litigate anymore. Certainly restaurants were mandated to not only close, but also be 6 feet apart. A lot of companies were directly affected to COVID. You might not meet that 50 or 20% threshold, but if you could show you were directly affected by direct mandates or indirect mandates through supply shutdowns. And now when you see or hear radio ads, TV ads, email blasts that you get weekly from all of these plethora and predator type companies, they're claiming every company could qualify for ERTC. They're charging 20 to 30% as a contingency. And they're like a casino. They're playing the numbers game, because if they do 1,000 of them, and let's say the average price is, $200,000, $1 million on a credit, because they're claiming that you get credit for all 6 quarters, they're charging 20 or 30%. So if you do 1,000, and let's say even on the low side, 20, what I say, 1,000 times $1 million for a credit, that's $100 million. 20% of that is $20 million. If they're getting contingency alone on that, they're playing the numbers game, because they're putting in their agreement that they will return their 20% if the company gets audited. They'll defend you on an audit this by just saying they'll send an explanation of why they did it, when you might qualify, or they'll return the $200,000 as their agreement. But if assuming the IRS cannot audit 100% of these, so if they audit 10% and a company like this gives back 10% of the money, they've made $18 million by claiming that your company was shut down due to COVID. The issue with that from a tax side is A, it could be fraud. The other side is there's a 5-year statute to amend these payroll tax returns, and payroll tax returns are a personal liability. They're not protected by the corporate liability. So even if your corporation goes out of business in the next 5 years, the amended payroll tax return is a personal liability. And also too, the statute to amend your entity return is 3 years. The statute for these amended due to ERTC is 5 years. So for instance, in my example, if you have to give back $1 million to the government, the ERTC company might reimburse you $200,000, but 5 years ago, you've picked up that $1 million adjustment on your tax return. You've paid maybe $300,000 or $400,000. You can't now go back and amend that tax return 5 years ago because you're out of statute. They're not explaining that piece as well. We're getting a lot of literature directly from FAQs from the IRS concerned about these companies claiming charge closures. And also the supply chain has to be US. So we can't just say we couldn't get product from China. That in itself doesn't qualify either. Our fee, the way we do it, we estimate the credit. We estimate, first, we estimate eligibility. We estimate the credit. And then we give you a fixed fee proposal. It's generally, we don't do it on a contingency. We're an accounting firm, we can. But our fees are always much less, always negotiated before you actually sign anything. A lot of these other companies make you sign on their website if you qualify. And then once you sign with them, you're stuck with them. You can't even change your mind because they have it in a writing that if you choose to use somebody else, you still owe them the 20, 30%. So again, a lot of companies qualify for this the legitimate way by revenue. We don't play the game of this gray area. We're concerned. We do have companies that we refer to that have attorneys on staff. They have CPAs on staff. They understand the mandates, the closures. They look at each government website for each jurisdiction as low as the local municipality. Those companies I trust, but be aware of some of the other companies that claim you qualify because you simply are just a company that existed during 2021. So beyond doing research and development credits and a lot of other credits, looking at QBI and a lot of things for tax efficiency, this employment retention tax credit really could be a sizable refund for you and your clients. And also too, the other part too, it's not taxable in New York State. It is a federal tax and it's a reduction of the expense, but New York State allows those expenses. So we're only talking about federal income tax anyway. So, and we don't charge, like I said, we don't charge to look at the eligibility or even to estimate credits.
So you got me started with a whole bunch of questions now, but the first one is, it's not as simple and not as straightforward as these commercials are making it out to be, but simplify for me. So I was in the travel business as in, back in those days, and travel was one of those industries that came to a complete halt. And we went through PPP1 and they held on to us for as long as they could. And then eventually they had to let us go because there was just no travel. So in ERTC, if they let me go, do they qualify for money, or do they have to, is it based on, because you say it's based on revenue, is it the employees that they kept with them?
Yeah, it's based upon the revenue is how you first qualify. Then the calculation is based upon the wages that they've kept. Again, another qualifier, like I said before, is if you had these, if you completely shut your doors, but you paid your employees not to work, you could qualify for ERTC. Again, we don't have a lot of clients that close their doors and didn't pay, still pay their employees the full boat. But in your example, Jamie, the company would qualify for the wages they've kept. Maybe they've kept administrative staff. Maybe they've recut their workforce by 50%, kept the 50% on payroll. Those 50% could qualify as far as the computation. So first you have to see if you actually qualify. You could qualify, but if you didn't pay anybody wages, then there's no calculation anyway. So it's kind of good news, but why do you need the good news?
Well, so keeping with that example, they kept a certain amount of people on staff, obviously, because the business was still having some activity, but it was like the continuation of the PPP in essence, and this is a refund, as you said, it's not even a credit anymore. Now it's so if I paid those 25 people, and I spent whatever $400,000 on those people, I would get up to $21,000 back on a per person basis.
21. Again, the big number that you always hear in commercials is up to $26,000 per employee. They don't tell you how to get there. But again,
right.
It could be the big home run. That's the big number.
All right. The other question I have for you is on PPP 1 and 2. the story was that you probably won't have to pay it back. So did you find, historically that your clients, they got that money and they got to keep it, or did anybody have to,
Yeah, no,
this was like a loan?
99%, I would say 99% of our clients got the forgiveness because they've kept employees. It was sort of an easy calculation to get the forgiveness. We have a few clients that their threshold, they made, let's say they got $150,000 loan. They've only had $120,000 qualifying expenses, so they might have a $30,000 loan still in their books. But we find most of the people that did it right, that got the money properly, were able to get the forgiveness properly and support it both in payroll and other qualifying expenditures like rent, utilities, leases, and a few others. So the forgiveness
So
part,
interesting. So interesting. And, it was a very difficult time. Obviously, a lot of industries are shut down, and a lot of companies and a lot of people were impacted. And this was a way of keeping things afloat.
yeah, and then, like I said before, when I look back, because I'm a taxpayer, obviously, and we're all going to pay for this at some point because it's trillions and trillions. They estimate the PPP fraud was estimated at $800 billion. Now think about that. That's 800 billion. They estimate the ERTC is already up to $3 trillion. To get your refund.
Wait. Is that in refunds or is that in fraud?
That is fraud. That's
Wow.
in fraud. Because when you do a tax return and you have to amend it because you've claimed a loss or you claim something, you actually file a tax return with the government. This ERTC, the only thing you actually file, even though we do the calculations, we give it to the calculations, we support it, you don't remit that with your payroll tax return. All you do is everybody has a 940 that has employees, and 941 is your quarterly employees. It says you have 38 employees, we paid 38 employees, $720,000, for instance. All the IRS is getting is an amended 941X, and still shows the 38 employees, still shows $720,000 of wages. Then there's calculations in 2 lines where you show they're entitled to this ERTC refund of, let's say, $250,000. And all the IRS gets is a new 941X and says, please give me my refund. The IRS is sending checks out, and anywhere from 3 to 10 months. Some are being held back because they think they're going to be audited, or they're just looking at it closer. But there's no other proof that you have to send to the IRS. The only thing IRS has to do then is audit it, but there's no documentation. It was rolled out so quickly. They should have mandated that there was documentation submitted, but that's not the rules. When you send a tax return, you have to send your documents, your supporting schedules. This is just the same 5-page 941, and it's called a 941X.
So I'm going to summarize, and not to be political, but maybe a good idea and maybe a bad execution.
Yeah, it was a good idea, bad execution, at least in the fraud. But again, when did we close? Probably March 17th. We were planning on a week later, but we were told that we're going to close because this thing that started on March, whatever it was, 8th, was coming quick. Everybody worked remote. But then you looked at the streets in New York City, you looked at your clients and said, the world is coming to an end. We lived through 2008. And that in my lifetime was the Great Depression of a recession. Companies going out of business. This one is, how can we possibly survive? Because this is a worldwide business shutdown. The fact we're sitting here almost 3 years later, the last 2 years economically were very good years. We're coming into now just a light recession. Hopefully it's a soft landing, but this has kept people in business, kept people employed. Just concerned from even my clients, we tell them is, even if you got that $1 million that you think is found money, doesn't mean next year you're getting $1 million again. So don't buy a Ferrari, don't buy a vacation home. Keep your business, look at where you're going, keep your employees employed, look at your next 3 to 5 years, keep your business active. It ripped off the Band-Aid of when you were bleeding, but it's not an end all or be all. And that's what it really was in my mind, is a subsidized unemployment that everybody got to keep the businesses open. Everybody else who's claiming it is just, they want found money. They are committing fraud, and that's a concern.
I want to change the subject slightly and jump over to Tom for the next half and say, we're talking about credit cards. And Tom, it's actually a topic that you and I discussed probably about 1.5 years ago with a client that was facing this issue. And you call them surcharges, cash discounts, and convenience fees.
Right.
And just to throw in my 2 cents worth, because sure enough, I had a bill the other day, and I looked at it. I know it was a restaurant. I don't even remember where I was, but I just remember I'm thinking about you. I read the bill, and it's total, and then there's that one extra line, convenience fee, and they threw a couple of dollars on there. And so tell us that what is the difference, and what are the legalities, and how does this affect businesses these days?
Good morning, everyone. So basically, since credit card acceptances have been around and merchants have had the ability to accept cards from their consumers or customers, those fees, they're trying to find ways to either minimize or erase those fees to accept those cards, those merchant service fees. So there's really 4 types, really 5, if you include what I call informal surcharging, but there's 5 flavors. I really only deal with 1, but I'll talk about the 5. There is convenience fee, flat fee, convenience fee, percentage fee of the volume of the sale, surcharging, cash discounting, and then what I call informal surcharging. Informal surcharging is the merchant does it on their own. You go to the auto body shop and say, it's $1,000 for your service. Oh, you're paying by card. I'm going to throw an extra hour of labor on there, or hey, you didn't tell me you're paying by credit card. And they do it kind of informally, and they make it a miscellaneous item and whatnot. The other 4, I'll start with the 3 that we don't really see often, but people may be familiar with. And then I'll talk about the one that I concentrate on, which is cash discounting. Convenience fees, there's 2 flavors. Anybody that's ever purchased a movie ticket, say on Fandango or Movie Phone, I say Movie Phone, it might be a famous Seinfeld with Kramer, what is if you remember that scene, but I think that's actually not a real company. But say Fandango, me and Greg want to go to the movies tomorrow, and as a convenience, rather than paying in person at the movie theater tomorrow, I could buy them online or on the phone, right, without being there in person. And that convenience, they can charge me a flat fee. Say it's $2, $3, or whatnot. The basic rule to keep in mind there is that merchant, the movie theater, has to have the ability to accept that same form of payment, in this case, plastic, in person, right? So they have the ability to take it in person, but they can offer you a convenient way to pay from the comfort of your own home or your phone, and you could pay that way, but you pay a convenience fee to do so. That's the flat rate version of convenience fee. I think most people are familiar with that. The percentage rate version of convenience fee, quickly to touch on that, is even more rare. That's only concerning government organizations and some education MCC or merchant category codes. So it's very rare, but educational institutions can charge a percentage rate for that convenience fee, and so can some government entities. Very rare that I come across that, but those are the 2 that get lumped under convenience fees. Moving on to the next type, surcharging. This one I don't deal with as much because a lot of regulation and policies from the Visa MasterCard standpoint. So basically, a merchant would have to, the goal is to charge X and then surcharge on top of it. So if the cost of goods sold was $100, they want to pass along, say, 4% or 3% to the cardholder, and they make the sale amount higher. They surcharge it. To do that, you have to register with Visa MasterCard. You have to notify your customer base with signage or whatnot at least 30 days prior that you're going to the surcharge program. It's illegal in some states, although that list is dwindling. The 3 states now that it's still illegal to surcharge are Massachusetts, Connecticut, which are both close by to us here in the New York, tri-state area, and Colorado. It's actually illegal to surcharge. In the other 57 states, it's permitted, but you have to jump through some hoops. And another caveat is the rate of the surcharge for credit card is different than a debit card that you sign for, or what's called a check card. So there's 2 tiers. So there's and merchants don't like that because they feel like they're deceiving the merchant or pissing them off with that, for lack of a term, with that verbiage surcharging. We'll get to questions in a minute, but I'll move on to the final one, which I deal with much more so on our team, is cash discounting. It's surcharging, but in reverse. And the technical way you're supposed to do it is you set your prices higher at the credit card price, and you offer the ability to discount down if the consumer pays by cash. So in the case of that $100 cost of goods sold, you would make your product $104 and then say, okay, Greg, we offer a cash discount. If you pay by cash or maybe check, we'll lower it back down to 100, and you can offer that discount. It gets to the same point, right? If you paid by plastic, it's $104. If you pay by cash, it's $100. But you're cash discounting because you're allowed to offer a discount from the time the credit card processing was invented. You can offer a rainy Tuesday afternoon discount. You can offer a discount for people that wear blue headphones like Jamie's wearing. You've always been allowed to discount down your product or service. The surcharging part has the more rules to it, but you've always been allowed to discount down. So we concentrate on that. It arrives at the same point, and basically what happens is that $104 sale would process just like a regular credit card transaction on what's called the batch out overnight. And we, the credit card processor, take out the $4 overnight, fund the full $100 to that merchant. Say it was a restaurant in this case, they get their $100 for their cost of goods sold. The consumer paid 4% more, which is at the end of the day what the consumer sees on their side. So they paid 104, and we keep the $4. That is taken out on a daily basis out of the overnight batch, and then at the end of the month, that merchant doesn't have a bill to pay our fees at the end of the month, because on a daily basis, batch by batch, sales by sale, the consumer was basically fronting that cost. And that's cash discounting. It gets very confusing the more you dig into it, because it arrives at the same point, like I said, as surcharging, but it's how Visa and MasterCard look at it. You could start high and come down. There's no rules and regulations to worry about. It's legal in every state, and you could always discount down. The surcharging going up the other way is where you have some more red tape to it, more policies and procedures to it, but it arrives at the same point. The last thing I'll mention is what I think will happen even more in the future, because we're seeing this more and more, right? You pay online, you see convenience fees, you pay at a restaurant, you see these fees passed along, is that you'll see maybe two-tier pricing like a gas station, right? In the New York area, we're all familiar with that. It's not true at every state, but you have the two levels. You have a plastic, which is the higher price, and you have pay by cash, which is a lower price. You'll start to see that, and I've seen it in a couple of retail and restaurant environments with a merchant. It's up to them on their side how they present it to their consumers, the cardholders walking through the door. But you'll probably see more and more of they'll set $104 and $100 for that product or on the menu, and that way the key is in Visa and MasterCard's vantage point is no confusion and no calculation. That's the ultimate goal. Don't take your cardholders, your customers by surprise, Mr. Merchant, and don't make it difficult for them to figure out how much they're going to have to pay you. And that's two of the main goals of any of those programs that I mentioned to you.
All right, couple of quick the rapid fire questions. You ready?
Go ahead.
The gas pricing, that's called that would be a cash discount example.
It can be. It's a flavor of how it's presented. Yes, a merchant, if they're willing to offer, for example, I went to the taco place, a Dirty Taco and Tequila in Rockville Center, and on their menu they actually had.
What are we? Are you getting paid to promote these companies now?
I like tacos. Tequila, not bad, but they'd have a cash price for that taco / card price. So $8 and $8.25 say, and it's right there. So I wouldn't call that cash discounting. That's a way to position cash discounting so that you can do it as a merchant to accomplish the goal of not confusing the cardholder and not making them calculate anything.
All right, you just confused me even more so, but okay, I'll
You're
stay
welcome.
with that. Ticketmaster, forget about their whole debacle there. Would that be a convenience fee?
Yeah.
Not that I've bought a concert ticket in a long time, but I'm assuming it's a flat rate. And so that would be, like you say, the movies, a Ticketmaster is, it's X amount of dollars for the ticket, and I'm charging you a flat fee of X amount of dollars for convenience.
That's a convenience fee. And again, they may have other service fees on top of it, and they have a lot of fees. If you ever bought a ticket for an event, there's a lot of extra fees. But in that environment, for the sake of this conversation, that would be a flat rate convenience fee.
All righty. And then again, going back to the restaurant. or the restaurant or the company that says it's $100 if you pay by credit card, and it's 96. I'm using backwards example, but same thing. It's $96 if you pay by cash. If the restaurant's presenting that, what would you, how would you, which one of those things would you call that? You get a cash discount kind of concept?
Yeah, I would call it cash discounting because it's really how it's presented on their menus and their signage, and then their staff, how they present it. But just a quick note, Jamie, if that true cost of goods sold is usually $100, they'd want to do it in my scenario where it's 104, 100, rather than take 4% of their margins right off the top to pay by cash.
It's funny you say that, because again, this is a conversation Tom and I had with regard to a retail client that was questioning how they should process this. They wanted to offer a cash discount to people who paid by cash, but I asked them, because how do I describe it? They're an in-store purchase. It wasn't like an online purchase, or like a movie ticket, or a DoorDash where it's all done electronically. You know, this was truly the in-store retail purchase. And I was questioning them on the idea of the cash discount, because that was motivating people. And Greg, we're going to come back to you and ask this from an accounting and business question, is if they're asking for cash at the cash register, or they're incentivizing the customer to pay with cash at the cash register at point of sale by giving them a cash discount. Isn't that complicating the process even further? Because now you've got cash, you've got miscalculating or miscounting, and then you've got to take that money to the bank, and you know, all of the things that are related to holding on to that cash versus swiping that credit card and being done with it and not having all those issues. So the question then became, should we raise our prices and offer a cash discount, or do we add I don't know if you call it a surcharge or a convenience fee on top of it? So I'm going to go, Tom, you go first, and then Greg, I'm interested to hear what you think about it.
It's really ultimately the merchant, the business owner's decision. But from our standpoint as a credit card processor, we prefer cash discount because there's not as much red tape to settle up. And we can do the same rate for credit card and what's called a check card, not PIN debit. So we can set it at the same rate. The surcharging program there's a different rate structure for credit card versus check card. To quickly explain check card, if you ever gone to the grocery store and they said credit or debit, right? It's a little confusing. You're like, well, I have a debit card in my hand. What they're asking is, if you think of it as a fork in the road, if you say credit, it's going over the credit card network. If you say debit, it's going over the ATM network. And there's a little bit of a different fee structure. It matters to the merchant, not to you. It's still coming out of your bank account. But if you say debit, it's going down one path. If you say credit, it's going down the same path as all other credit cards. And if you say credit, you're going to sign, right? We call that signature debit or check card debit. If you say PIN, you're going to enter your PIN code. PIN debit is not a part of either of these programs we mentioned, talking about cash discount or surcharging. So a merchant would no longer you can't charge that surcharge on PIN debit. That will further complicate more, and force some more questions. But you could disable the merchant's equipment so it didn't have the option of PIN debit. And the cardholder really doesn't care, as long as it's coming out of their debited from their checking account. That's what they really care about. So that adds an extra layer on what the equipment can do. But to try to answer your question, Jamie, it's really on the merchant side, whether they want to start here and surcharge up or go up and discount down.
So that's why I swing over to Greg. You're going to advise this client as their accountant, billing and processing and handling their money. Is there a difference to you if there's a credit card surcharge or a cash discount?
No, not from the accounting side, of course. And it's just legality side, because I know it's terminology, it could get yourself in trouble. But as Tom said, it's really based upon the point of sale system and the vendor system, the credit card system. The accounting really shouldn't matter. And the inconvenience of either or both is really the reason why these companies offer the cash discount, is so they don't have to pay the 2%, 4%, 5%. So that's why they do it. However they get there, from my standpoint, doesn't technically matter. It could be a sales tax adjustment, but all of that should be, if they have the right point of sale system, shouldn't matter because all these merchants are getting cash and they're getting credit cards. It's rare where you're gonna have a company that's total credit card or a company that's total cash that gets a one-off for either. So they're used to both systems.
Interesting, interesting. Well, Patrick is here to see us. So Patrick, do you have any questions for these two geniuses?
I actually have questions for both of them. Thank you for presenting. I apologize for being late, but I didn't see the new credentials come out.
Oh, sure. Now, yeah, he threw me under the bus on that one.
Tom, just quick question. POS systems, can they be programmed with a cash discount?
Yes, so that opens up a whole other topic on the equipment side, but yes, so in our world with cash discounting, there's smart equipment that, for example, we use what's called the Clover system. Some people know that system, and you could download apps on top of that, and one of those is a cash discount app, and it makes the inventory at the point of sale that % higher, and then gives the cashier the ability to get to discount back down. So it's on that type of smart equipment. On a regular old school credit card machine, it doesn't have that ability. So we do it over that smart equipment.
So do you only use Clover equipment?
We only offer, that is our only option for selling equipment, but we can offer the cash discount program on another vendor's POS system if it has the capability, which it usually does nowadays.
Very cool. Hey, Greg, just one thing that jumped out to me. You said if the IRS comes in and is doing an audit on a company, they could actually go after your personal accounts.
Correct. Yeah, when it comes to payroll, that's a personal liability. Whoever signs those returns. So it's very risky. And of course, none of these companies are ever going to tell you that. And no, none of these companies are advertising that there's a 5-year audit period. They only tell you good stuff. They never tell you the bad stuff.
I'm glad I joined this meeting today because somebody reached out to me last Thursday and said, Patrick, you're going into all these businesses. You should start talking about this and we'll cut you a piece of the pie on the tax credit. So glad I didn't say yes to that.
Yeah, depending who the referral, there are good ones out there, and they all say, because if you're getting 30%, they'll of course say, Pat, well, I'll give you 5%.
Right.
They're making 25. So it's just, like I said, it's just cash to them. But you have to be careful too of the referral source. Again, it's not the risk necessarily on you. It would be your companies if you were doing it, but just your referral sources, you want to be careful.
Well, and I don't want to be that, turn out to be that bad guy,
Yeah,
working
it's just
too
not
hard
worth
to
it.
stay clean, right?
All right. Well, I want to be good on everybody's time, so I don't want to run past our deadline. So I want to thank both Greg and Tom for participating today. And Patrick, it's good to see you. And unfortunately, there was some confusion with the credentials, but I will get that one fixed going forward to the next one. In the meantime, I think the two of you have really clearly identified why accounting is so much fun, because there's never a simple answer. Everything has a whole bunch of rules to it, whole bunch of exceptions and twists and turns. Tom, leave us with something brilliant.
I got it. So one thing I did not mention is that merchants, what we find, one of the benefits of doing cash discounting is to avoid a true price increase. And what I mean by that is you could tell your client base, we're honoring our prices for, say, the last 5 years if you pay by cash. If they pay by card, obviously it's a different story, but they're spinning it that way and saying, as a way to offset a true across the board price increase, we're honoring our prices from 2017 or whatever year, whatever way they want to phrase it, by paying by cash. Thank you for being a valued customer. So merchants, if they get it in their head that way, they have positioned it that way to themselves and then to their client base.
It always makes me concerned when the credit card guy wants to pay by cash. But
Hey, we'll be okay at the end of the day. More and more sales are going over credit card, but yes, it is a bit of an oxymoron.
Well, I think it's even easier to say is grandma pays with cash. I'm a hybrid, and my kids, they don't even know what cash is anymore.
Yeah.
So,
Yeah.
it's the way of the world. I still get a kick out of it. Like we were brought up, if it's under $25, can't use your credit card. And I love them. They walk, I was going to go into Starbucks, but it's not cheap. But they go into the store and for $2.35, they pull out their credit card. I just can't imagine what that bill
Yeah.
looks like at the end of the month. It adds up. But I thank you both, and thank you, Patrick, for joining us. My name is Jamie Austin, and this was a PSP Turnkey Solutions educational workshop. If anybody would like to meet with either Greg or Tom, you can reach out to me at Jamie at pspturnkeysolutions.com, and I'll be happy to put you together with these guys. So thank you all, and have a great day.
Thank you all
Thanks,
as well.
everybody.
Have a good one.
Wait,
Thanks,
thank you,
Jamie.
Jamie.
Bye, guys.